Hello, everybody. Thank you for joining us today on this rainy Tuesday lunch. So thanks for joining us, and we will get started right on time. We've got some great information to share with you. Today's lunch presentation, as we're always looking to keep you informed and updated on best practices, today's topics are navigating M&A success, market trends, and deal structuring. So we're going to jump into kind of the overview of what the market trends are, but then also tell you about the local trends here in the Buffalo area and share with you some best practices and what we're seeing going on and how we're helping some of our clients. So hopefully it helps you. I'm Carolyn, I'm your host today, and I'll just do the quick housekeeping here. If you have any questions, there is a question section that you can put in there, and we will get them answered throughout the presentation and or at the end. Also, too, there is a handout section that you can grab a copy of today's presentation, take notes along the way. We will also send you a survey right after the presentation asking if you had any questions, if you want to meet with one of our experts, and if you have any topics you would like to hear in the future. So if you could complete the survey. And then this afternoon, I will send an email out to you with a link to the recorded session. Again, another copy of the presentation. If you want to go through it again or share it with somebody else, you can do it at that time. So I'll send that this afternoon. I think that's everything for housekeeping. So without further ado, I'm going to introduce our experts, Mark Ferm, Pat Sullivan, Josh Thompson, and Mike Baritot. We got a great group for you today. I won't spend a lot of time on their bios, but just real quickly, Mark Ferm is a partner here at the firm and CPA holder. He's been over 25 years in public accounting. He does head up our M&A transaction advisory services at the firm. Mike Baritot is a Master's of Science in Taxation and has been in the accounting industry for over 30 years. He works with closely with a lot of individuals, business owners, and family to grow and preserve and distribute their wealth, looking to minimize the impact on taxes. Pat Sullivan is a CPA here at the firm and has over 9 years in the accounting industry, does a lot of business valuation, due diligence for M&A projects and financial modeling. And Josh also is 6 years in public accounting with broad range, very similar to Pat's business valuations, financial modeling and analysis, quality earning reports, and much more. So we got a packed house of good expertise today. But before we get started, our experts want to know a little bit more about you. So we're going to do 2 quick polls. Let me pop over to those. Find that on the screen. Bear with me. All right, there we go. First poll today, what are you looking to learn today? We've got a couple different options for you. Guys, hopefully this is matching up with what you're going to talk about. Hopefully we're getting it right.
Yeah, we can always pivot.
We can jump to whatever we need to do. So I'm going to give this just a minute, see where everybody's at. It's like some of them are both sell side and buy side. And then there's some people on here just looking to learn more about the trends. Give everybody a minute. All right, looks like most people have voted. So to keep this moving, I'm going to close it out, share the results. Again, it looks like both side, sell side and buy side, and looking at the trends, but there's a little bit of everything in here for today. And then our next one, which stage of the M&A process are you currently in? Where do we think this is going to come in at, guys?
I am going to go short term and say within the next 6 to 9 months.
I'll go with the 9 to 18. I guess.
Yeah, I'll go looking for an opportunity. Something. Pretty early stages.
All right.
Yeah. I'd say early stages.
Give everybody just another minute. Close it out. Let's see what everybody has to share. So it looks like a lot of people are curious. Half the group, so and then other people are at different stages. So that's your audience, guys. So let's give them the update, and I'm going to hand it over to Mark to jump us right in.
Sure, great. That's thanks, Carolyn. Very helpful. Wanted to also extend an appreciation for my fellow colleagues here today, talking about market trends and some other things that we're going to cover today. This is a second of a series of quarterly updates that we're going to provide. So really excited to be in our second of that series. And, you know, for those that, as Carolyn mentioned, we always ask for feedback. And in that feedback, from our last series, we did hear that our participants want to hear a little bit more about deal structuring and tax considerations. So we added it to the agenda for this time. So I think each quarter is going to include a market update, which we'll talk about 2025, some M&A deal activity, private equity, as well as some insights into kind of what we're seeing in the Buffalo market. And then add on, you know, one or two topics of interest. And so today we'll talk about deal structuring and tax consideration. So please give us your feedback. We want to know what you want to hear about, and we're happy to add those areas of interest to our third installment, which will be coming not too far down the road here. So I'm hoping that we were able to celebrate a Bills win for those that are in Buffalo, New York, but unfortunately we can't, although we do have a number from Southern Ontario and Toronto. So you're hopefully going to be celebrating Toronto Blue Jays win over the Yankees tonight. It's 2-0. So for those that are in Southern Ontario, we'll hopefully have something to celebrate tomorrow. But without further ado, I will pass it on to Pat Matthews, who's going to start us through the market update.
Awesome. Thanks, Mark. Yeah, so similar to last time, we're just going to, at a 1,000-foot view, kind of look at the macroeconomic environment as a whole. Then we'll jump into the M&A specific trends. And then to finish it off, we'll talk about the private equity trends as well. So similar to the last presentation back in May, I kind of kept the same scheme here. So on the left-hand side, this was the 2025 market outlook as of late 2024, early 2025. There was a ton of, really sentiment was at an all-time high, as you can see from the Citizens Bank survey here at 54%. So people were really expecting and predicting a lot of gains from the prior 2 years, the lull that we've experienced. So there was a noticeable rebound in optimism, renewed confidence, largely driven by economic expansion, a stabilization in inflation, a new administration coming in, and hopefully all these things kind of together would bring more predictable valuations and kind of close that valuation gap we've been experiencing in the past couple of years. So, and then on top of that, the economic uncertainty that we did have, like I had mentioned, people were hoping that inflation would, again, start to fall off, go back down to the Fed target of about 2%. This was supported by the Congressional Budgetary Office's projections of CPI, or Consumer Price Index, to be below 2.5%. So everything was looking like a ripe year for M&A deals. And then as we kind of progressed to today in the first quarter, the main topic of the first quarter was tariffs. There was a ton of uncertainty that came through on the back half of the quarter. So I think that stalled a lot of M&A activity towards the end of March, beginning of April. But I really do think, and I don't know if anyone else has any relationship to this, but I don't know if the tariffs were as big of an impact as we were all expecting. Obviously, things were being negotiated. But again, I think the bite was bigger than the bark, or the bark was bigger than the bite in regards to the tariffs. So, so then I guess we jump to today. the labor markets. The one thing that has changed is it seems as though the labor market has begun to weaken a little bit. So that's a little bit concerning just because we have counteractive influences here. We have the next point here of inflation remaining sticky. So like I said, it's I think around 2.7% year over year change. So that's above the target of 2% that the Fed is looking for. But again, our labor market unemployment is rising. So these are two kind of conflicting issues. So curious to see ultimately how this shakes out and what they end up doing with the rates. But in regards to the third bullet point of, I think everybody's at the point of just accepting this uncertainty as the norm. And what I mean by this is people are just preparing different scenario analysis to see what the low end, what the high end, and everything in between, where they're ultimately going to shake out. And although inflation is, like I said, it's a little more elevated than what people had hoped, it's been relatively consistent. I want to say it's fluctuated, I think, between 2.3 and 3%, but it's staying within this range. So I think people are more comfortable moving forward, knowing that we're not going to be experiencing any major spikes, hopefully, in the near future. And then the last point, steady declining interest rates. The Fed Reserve has held the rates steady at 4.25 to 4.5 for most of 25, and we just got a recent cut of 0.25% in September of 25. So I think the timing of future rate cuts is a little bit uncertain due to the labor market and then inflation remaining high. But so I'll be curious to see where that ultimately shakes out.
Yeah, I think, Pat, maybe I just want to jump in here real quick. A couple of thoughts on, the labor markets. I think that one of the things that businesses are still a little uncertain about, particularly in the services industry, is the impact of artificial intelligence and how quickly that can impact businesses. Again, we don't know if that's going to be a good thing, a bad thing. I think it's just an uncertainty there. And I think with the interest rates, it'll be interesting to see the impact of private equity in terms of that reduction of interest rates, and will that bring more private equity into the space, into the M&A space. But we've seen, at least in Buffalo, in the sort of low to middle market sector, that PE still remains to be active, regardless of the interest rate environment. We'll talk a little bit about the structuring portion of this and why that's the case.
All right, perfect. So yeah, jumping into the M&A trend specifically, Q2 deal volume. So in Q1 of this year, approximately 4,900 deals closed. Q2 kept pace with that at 4,800. So that really, it's been pretty consistent year to date. But the more important thing I want to emphasize here is the year over year change was a 10.7% increase from Q2 this year to Q2 last year. And this is the same exact trend that we experienced in Q1, where there was a 14.6% increase from the prior year. So all that being said, I think we're finally, the optimism that was had at the end of 24, beginning of 25, hoping that that's actually starting to pick back up now that tariffs are hopefully falling by the wayside. And the lulls that we experienced in 23 and 24 were really getting past those. The deal value, so it dipped a little bit. So this is total dollars that basically have been transacted. Quarter over quarter, 3.2 dip, but year over year, 31.3%. So, a portion of that does relate to the increased transactions that occurred, but a lot of it is just larger deals that have happened that are kind of bringing that total year over year increase to that big of a high. The next piece of it, we kind of touched on it, the economic factors. I think that, yes, tariffs were an issue at the end of the first quarter. We saw the impact, but those, like I said, seem to have subsided for the most part, not saying entirely, but then I also think the steady interest rates, the Fed, starting to cut, we're starting to see inflation kind of staying steady. We're starting to see these things normalize and stay consistent to where people are willing to go out there and be participants in the market. So hopefully that trend continues. And then one thing I wanted to try to do this time is tie this into the lower middle market. So the one piece of this is, and we'll actually touch on this more in the deal structuring section, but a lot of these buyers are using rollover equity and earnouts in this space. And I actually found a study specific to this, to where this was actually deals under 50 million. So in the past, for earnouts specifically, so what these do are, the rollover contributions and the earnouts are a way to bridge the valuation gap. So there may not be as much cash consideration paid up front. So they use these drivers to fill in that gap of value, so that owners are kind of achieving the total value of the company, may not be at that point in time, but over a period of time, through whether that's growth appreciation or they're them hitting specific metrics. So but going back to the earnouts, in 23, these deals under 50 million, we reached a high of all deals, or 39% of all deals included an earnout, 27% in 2024. And I actually went back to some of the deals that we did internally, and we had approximately 40% of deals had an earnout piece attached to it. So we're kind of trending in that same space. So that was kind of encouraging to say that, what we're seeing is what the market is seeing as well. Now jump over to the right, valuation insights. The multiples, I think we talked about this last time, but everything seems to be aligning to that evaluation reset has taken place or is in process of. So 23 to 25, 10.5 multiple, pretty close alignment to the pre-pandemic of 2015 to 2019 average of 10.1. And then further to support that, corporate-led buyers, we'll talk about it, but PE has been somewhat inconsistent over the past couple of years, just given the current environment, but corporate-led has been astonishingly consistent. Just to kind of show this, their low multiple came in 2018 and 2020 at 9.1, and their high was 10.2 in 2021. And at 2025, we're sitting at a 9.9, what they're paying for companies on their purchases. So very consistent, kind of, what you're getting. And I think they're, it makes sense because they're purchasing for strategic purposes to where they'll ultimately roll up underneath them. So, and then the last piece to kind of tie it down to the lower middle market is, everyone always talks about the valuation gap. Larger companies transact or command higher multiples than smaller companies. And I thought that the two graphs here really illustrate that. So the deals 25 million to $1 billion, you can see they're up, 11, almost 12 multiple. And then we look at deals under, and you can see it's down high 6s, 7s. So obviously this is a deal by deal basis. It can fluctuate depending on what is being purchased and everything, but traditionally larger companies, there's a number of reasons of why they may transact higher, whether they're typically seen as lower risk. They have more access to capital, established reputation, a financial operational history that's traditionally consistent, and they most likely have a more experienced workforce to where a smaller company may be relying on key management and owner. So these little things cause the disparity that you're seeing here. And like I said, it's not every single deal, because there could be specific synergistic value, cost savings, geographic, whatever the case may be, that would drive multiple up for a small company. But inherently, it does seem to be a difference between the size of the companies. And then the last piece of it here, private equity. Try to get through this so we can get into the meat of the presentation. But transaction counts down quarter to quarter, but again, up year over year. Valuations, they're still remaining elevated, because I do think that they were paying for premium companies in the past couple of years, because of point number 3, the exits and holding periods have continually increased. So basically what that means is these PE firms are holding on to companies for an extended period of time. And what's happening is there's pressure on them to offload these companies, liquidate, so that they can pay their limited partners and investors. So with them holding on to that these companies, basically their cash is tied up for the time being. So these companies, it's just starting to compound to where really everything is coming to a head because they're just unable to then fund the LPs and give them the return on investment. So it'll be interesting to see what ultimately happens here, but hopefully, like I have here, best case, trade policies settle, inflation subsides, and it creates a better environment for them to exit so that the general partners can exit at higher valuation, pay off the LPs, get more cash, and then those limited partners or LPs will, again, use that cash to invest in new companies that they can hopefully go through the same process again. And one of the things I actually thought it was interesting was it's all kind of tied into this, but their fundraising activities for PE is actually, it did very well the past few years. However, it's starting to dip. And I think that's because they're unable to exit, unable to furnish that liquid to their LPs, and LPs are just either not willing or unable to fund these funds that are being set up going into the future. So it'll be interesting to see how it all shakes out, and I think the economics will be a piece of the pie there. So
Yeah, Pat, one of the things that we've seen a little bit here in recent years is that the larger PE firms sometimes are setting up multiple funds. And so when they need to exit an investment, if they can make an investment case to say their second fund, they will replace the first investors to get them return on capital and have a ready source of cash to allow for that monetization event. And so it's a real sort of creative thing that a lot of the larger PE firms are doing to allow for that liquidity event.
yeah, so it's definitely an evolving thing. I guess we'll kind of see how everything shakes out, but hopefully it will start to subside and see what happens. But I think next we're gonna jump into the Buffalo market, and I'll pass that over to Mark.
Yeah, thanks. So thanks, Pat. Appreciate that. I think some of the trends that we're seeing in Buffalo are consistent with our first presentation after the second quarter. And we are continuing to see cross-border activity from our Canadian neighbors. One of the things that we didn't mention in our last update, which we're seeing more and more of, are even domestic companies looking to come to Buffalo, New York, establish a presence here, either through acquisition or otherwise, because of the proximity to the border. And because if they want to open those Canadian markets, having access to those markets easily, and of course, any border city, some of the others in the Midwest are also, gaining some interest there, but Buffalo is also that, seems to be some level of interest there that we're seeing. So in terms of deal volume, pretty consistent that we're seeing this quarter. Multiples again I think are pretty consistent. As Pat had mentioned, we tend to see that most deals in Buffalo are 100 million or less. There's obviously some outliers to that, but they tend to be in that sort of 5 to 7 times range. Is kind of what we're seeing. And then similar structuring. We're going to get into structuring, so I won't belabor that for this update. I'll make some comments there when we get to that area. Employee stock ownership plans. We started talking about that last quarter, and that continues to be a trend. Many baby boomers who are looking to exit, who may want to keep the legacy of their business and or keep the jobs here in Buffalo, New York, are looking more and more to ESOPs is what we're finding, those employee stock ownership plans. And the baby boomer, again, that leads into the baby boomer conversation, that continues to be a need of exit strategies for that generation, many of which are their kids and families have left the area and need that additional opportunities or exit plan and options to consider. In terms of a deal structuring considerations, this is one of the, as I mentioned earlier, this is one of the topics that we had that we got feedback from last time. And so turn to that next slide there, Carolyn. Thank you. So one of the topics or questions that came up last time, what's the difference between an asset and stock deal? And we could probably spend, hours, if not days, talking about the differences and some of the tax considerations. which I'll bring Mike Baritot in the conversation here a little bit about the tax implications, but just want to cover this at a high level. The asset deal primarily resulting in the buyer being able to pick the assets they want to purchase and the liabilities, most importantly, the liabilities that they want to assume. And so generally, an asset deal is more attractive to the buyer from that perspective, as well as some other tax implications that tends to make it more appealing to a buyer, as opposed to a stock deal, whereas the entire entity, the stock of the company is going to be sold, and that'll be the company will be owned by either a new company set up by the buyer or some kind of holding company. And so that's where those differences are, is that the ownership in an asset deal will remain, the legal entity will remain with the seller, versus with respect to a stock deal, that entity then is now owned by the buyer. So on the tax implication side, Mike, I don't know if you wanted to kind of jump in here and kind of talk about at a high level what the implications are for the buyer and the seller.
Sure, thanks, Mark. Yeah, and obviously a discussion of the detailed implications from the tax perspective is way beyond the scope of what we're going to cover today. But high level, tax is generally the driver in this decision. In a asset deal, the buyer gets to step up in the basis of the tangible assets, and then any excess is allocated to goodwill and can be amortized over 15 years. The seller does not get a step up, required to pay tax at ordinary rates on the proceeds in excess of their basis. And it's a C Corp, it's actually going to be taxed twice, once at the corporate level when the assets are sold, and then again at the shareholder level when the proceeds are distributed out of the corporation. In a stock deal, the seller tends to be the winner. The buyer gets all the assets and liabilities at carrying value with no step up in basis, and the tax attributes are inherited. And the seller is typically subject to only one level of tax at capital gains rates. So stock versus asset is almost always a point of negotiation in any deal, to the point where it can even affect the total selling price at the end of the day. Simply because the tax consequences to buyer and seller are so adversarial opposed, if you will.
Yeah, and so thanks, Mike. And I think that one of the areas or discussions that we have with our clients, particularly if you're looking to sell your business, is take a look at your tax structure with your advisor and determine if there's any changes that you need to be made that need to be made well in advance of sale, or have those tax considerations well in advance so that you can plan accordingly. Because sometimes you get too late in a transaction and you're kind of stuck in some situations. So that planning perspective can be very important well in advance of a transaction. So on the rights and contracts, what goes into that is, in an asset deal, many times if you have significant vendor contracts, significant customer contracts, many times those need to be renegotiated because so the buyer has to renegotiate those contracts because you're dealing with a new legal entity. So in a stock deal, generally those contracts are sold with the company. However, it may not be as simple as that, because many of the more sophisticated and larger, say, vendors and customers in their contracts might have change in control provisions. So even if it's a stock deal, you may need to renegotiate those contracts as well. But generally, asset deals tend to be a little bit more complicated with respect to rights and contracts. In terms of purchase price consideration and structure, these are relatively intuitive. We just want to talk about this as a sort of backdrop to our next slide. But obviously, all cash up front. Usually, sellers like all cash up front, but generally, we're not seeing that. As Pat had mentioned earlier, about 40% of the deals that we see, and roughly the same amount in the market, is something other than just cash. And so that could take the form of equity. So seller, they receive shares in the acquiring company and or roll over their shares in the existing business. And also seller notes is another technique that the seller may need to hold paper and receive those sale proceeds over time. From a seller perspective, any of these types of tools that a buyer may recommend in the letter of intent, again, understand the tax implications and can you get deferred tax treatment over time. The last thing you want to have is receive shares and or seller note without any cash and not have cash to actually pay the tax. So again, very important planning point there. And then a hybrid, which is a combination of all three above, which is more and more kind of what we're seeing in sort of the hybrid method. So some of the structuring techniques that we see, as Pat had mentioned, earnouts becoming more common. These are performance-based payments, usually attach some kind of metric performance, either revenues or earnings. I think this could be good for a buyer to be able to plan out the purchase price and maybe even provide enhanced purchase price to the seller, because then if they meet higher metrics, it'll warrant a higher valuation. From the seller's perspective, obviously there's uncertainty with earnouts. You don't control the business usually after the transaction closes, so it's hard to control the performance and able to meet those earnout metrics, as well as the fact that you just don't own the business and can't control. There's uncertainty, and whether or not the important thing is from the seller is to understand, does the buyer have the financial wherewithal to pay that earnout when it's earned? Sometimes if they highly leverage the transaction, a buyer might be out of cash. And so how do they pay for that? It's a sort of important basic question to ask before entering into a letter of intent. Rollover equity, this is where the seller will either retain partial ownership in the selling entity, or sometimes a new holdco that's formed by the buyer. I think the important thing from a seller's perspective is to understand, where do your rights fall in relation to the other shareholders? Are they similar or the same types of rights? Are they senior? Likely not senior, but more importantly to ask, are they junior ownership rights? In other words, when there's a second monetization event, are you going to get the same return as other shareholders? And does that achieve your objective? Because obviously the more junior ownership rights are, the more risk that you have that you're not going to get the expected proceeds from the second monetization. In terms of, I'll talk about escrows and holdbacks kind of in tandem here with escrows. These are general tools where a buyer and seller will agree to a certain amount of funds set aside, won't be paid out at closing. And this allows that if there were misrepresentations during the diligence process or something that the seller did not disclose to the buyer has a remedy to take funds back basically out of either escrow or if they've held that back directly. So those are, again, all structuring tools that buyers use to help protect themselves. So what I want to do is then I want to turn it to Josh, who can talk a little bit more detail about additional items.
Before we do that, before I let you go and get off the hook, Mark, we have two questions that came in from Kathy. On the asset versus stock decision, is there a consistent preference by investor type, or does it vary on every deal?
I mean, I think it could vary. I think, Mike, I don't know if you have any thoughts there on that from a tax
I
perspective.
mean, clearly the objective from the investor's perspective is to one way or another ensure they get the step up in the basis of the assets, right? So they're generally going to be paying a premium well above and beyond the value of the hard assets of the business. They want to make sure they can recover that from a tax perspective. So that drives most of these conversations. It's rare to see an investor come in and offer to buy the stock, say a C corporation, and take on all of that additional value without getting the benefit of the step up from a tax perspective. I think that's pretty consistent with what we've seen, Mark.
Yeah, I think too, in a C corp, especially if it's a C corp, a buyer from a legal perspective would inherit all the liabilities, including any tax liabilities, right? If they hadn't filed appropriate returns in various states, those things are carried forward in a stock transaction. So, I would say that, yeah, most buyers would, probably prefer the step up in basis. If it were an asset deal, then they can leave behind the assets that they don't want to retain. So Carol, yeah, I think there's a second question.
Yes. Other than private equity and ESOPs, are there alternative exit options for family-owned legacy businesses, and for which you're seeing investor appetite in the Buffalo market?
Yeah, in terms of investor appetite, I would say that outside of a straight sale or an ESOP. So an ESOP would be where the employees would then continue to own the company in some form. And it's not the topic of today's discussion, but I'd say that other exit options might be bring in a key manager, CEO, to run the business and make it a lifestyle company. And from that perspective, you may enter into either stock appreciation rates or stock options to provide incentives to that employee over time to help you grow the value of the business. That could facilitate a management buyout over time. There are situations with an initial public offering, an IPO. It could be an option. I think we haven't seen much of that activity in Buffalo. So those are some of the other, and we've had in rare cases, although it's happened a few times in the last couple of years, we've had companies or owners give their company away to charitable organizations to meet charitable goals and objectives. So I would say that the other exit strategy we see outside of ESOPs and a straight sale would be a management buyout. Sometimes a gifting, right, to kids as well, or to family members, could be some gifting strategies or estate planning strategies. So there could be some things, opportunities.
Okay, great. Hopefully we answered that for you, Kathy. If not, throw another one in there. Otherwise, I will pass it over to Josh to keep us moving forward.
Yeah, no problem. All right, so I'm just going to quickly walk through this graph that you see on the screen. This is just a real quick way for everyone just to kind of understand how you get from the purchase price that you may see in the purchase agreement to the purchase price at closing or the purchase price at delivery, because there are some considerations that need to be taken into consideration to bridge that gap. So obviously, as we said before, as Pat and Mark have mentioned, most purchases are cash-free, debt-free. So you're going to see cash and debt taken out of the purchase price. There's also an adjustment for net working capital at close, and we'll get into this on the next slide. And this is a common purchase price adjustment at close, because what you're going to do over the due diligence process is establish a net working capital target that's designed to be neutral for both parties, the seller and the buyer. It's not designed to favor either side. As a result of that target being established, what's going to happen at close is you're going to have most likely a difference, either plus or minus, between actual net working capital at close in comparison to the target. So it's a dollar for dollar adjustment at close to the purchase price for that difference in net working capital. So again, the due diligence process can take anywhere on smaller deals, 3 months, anywhere to a year, a year plus on bigger deals. So net working capital is going to ebb and flow over the process, especially as you're doing your work. So a lot of the times, what's going to happen is the target that you're working with, again, your TTM period could be 2 to 3 months removed from closing. So, and again, we'll get into this on the next slide, but essentially, the chances of you hitting your target net working capital at close is very slim. I don't think we've ever seen that happen in a deal where target net working capital is dead on to the nuts on what it is at close. So there's going to be a plus or minus adjustment there. So, and then again, it's a dollar for dollar adjustment to purchase price. And then additionally, below that, you'll see all the ones that Mark just talked about on the previous slide. So you'll have an addition for any earnouts that are established between the parties. And then you have to consider equity rollover, your escrows and your holdbacks. And then transaction fees can also be rolled up into the purchase price. Again, this is kind of dependent on the buyer or the seller, what they want to do. But you'll see, legal fees taken out, the accountants, any third-party advisors, lawyers that are involved on the deal, those can be taken directly out of the purchase price at closing as well.
Yeah, I think just to add a couple points here. So, and a clarification: the earnout is a deferred payment. Parties, the seller won't receive that at close. It's paid out over time as they meet that metric. And I would say that the other comment I would say is that one of the common misconceptions is that a seller might expect that they would keep net working capital. Right, that's a confusion. Net working capital is built into the inherent value, multiple that's being paid by the buyer. And I would say that probably the most common disputes that we have with transactions is probably net working capital. It sometimes surprises people when they've never done a deal before, but net working capital is a thing. We spend a fair amount of time, right, Josh?
Right. Yep. And it always comes down to the end of the deal, because like I was saying, a lot of the times these deals take a couple months as you work through diligence. So your historical period that you're working on is going to be a little bit removed from actual closing. So a lot of the times, net working capital is the last piece to be considered in the deal, because you have to get through due diligence first, get everyone on the same page, and then really up to close, maybe like a week or two prior, you're hashing out networking capital with the seller, with the buyer, with the third-party advisors, with us, to try and get everyone on the same page in a very small window so that you're closing networking capital as close to actual as possible when delivery date arrives. So.
Yeah, and just to kind of jump in on this, I think that this is actually a really powerful graphic, because what happens is at the end of a close is you'll kind of go through what they call funds flow, to where you will have your base purchase price up here, but you have to take into consideration all of these ancillary things that are going to feed into ultimately what's the cash I'm getting on close versus, you know, what that base purchase price is. So there could be massive differences in regards to if you have half of the purchase price being held back for 2 years, you're not going to get that cash up front. Same thing with earnouts. If you're not going to get that for, you know, portion of the price until 5 years down the road, all that stuff needs to be considered, both for, you know, satisfaction of the seller as well as for tax implication purposes as well. So I thought this was a really powerful image.
Yeah, and one last thought, Karen, before we go to the next slide, is that net working capital adjustment could be extremely material, especially dependent on the industry of the business and how severely net working capital fluctuates on a month basis. So Karen, you can go ahead and go to the next slide, and we'll kind of jump into working capital. So working capital too will fluctuate month to month pretty dramatically based on the type of business, that the industry that the business is in. So when we do our analysis on working capital, we do our best to try and do it on a monthly basis. It depends on the accounting firm you work with, but some people do it on an annual basis, you know, a quarterly basis. We try to do it monthly because we've noticed in deals too, again, dependent on when closing is, seasonality of the business comes into play. So you can see from that first bullet. So net working capital target it's typically included in the LOI verbiage, but not always. We've seen deals that are super specific in the LOI, which is the letter of intent. And the letter of intent is one of the first documents in a deal. So it's very early in the process. So depending on how much information you can get pre-LOI between the buyer and the seller, it'll allow you to get a detailed net working capital target or a not so detailed target. So a lot of the times too, the seller can be hesitant to provide a lot of like financial information before the LOI, because again, there's no documentation that it's not exclusive yet. So again, depending on the buyer and seller, it varies on every deal. You may be able to establish a dollar amount for net working capital target in pre-LOI. At the very least, what you should establish in the LOI is how you're going to handle net working target. What will be included? What will not be included? Is it going to be cash-free, debt-free, which is very common. We see that all the time. And another thing for when you're establishing a pre-LOI working capital target is to include to consider the historical averages and the seasonality. So this is kind of what I was saying before. At close, your net working capital target is going to be different based on the season that the business is in. So a lot of our manufacturing clients, they are busier in the summer, slower in winter. We see some clients that work with school districts that are very busy in the summer months while school is out, and then not so busy when school is in session in August and September. So real quickly on this one, we had an example where, and historically with net working capital, what you want to try and do is do annual periods as well as a TTM. And that TTM is the trailing 12 months prior to close. And again, that'll give you kind of like an annual picture as close to close as possible. However, it can skew results if you have a business that's highly seasonal. So for example, we had a client that the predicted close date was going to be in December, so in a winter month. And the TTM period was including their summer month of June. And June was a super busy time for the company. So for example, their accounts receivable balance was typically way higher than average because they're super busy. They don't have time to chase down collections and turn over that accounts receivable very quickly. So in our historical average for net working capital target for this client, we considered a period from, I think we did October to February. So it captured sort of the normal operating conditions of the business and excluded the very high peak months where accounts receivable was much higher than average. So, and again, because at the end of the day, net working capital is supposed to be a neutral target that will exclude sort of the large peaks and valleys to try and get to a more normalized number. And then, so moving down to the second bullet, inclusions and exclusions as well. There's definitional exclusions of working capital. And depending on the deal, these can be hashed out in the LOI or purchase agreement. So they're specified to assist in determining consistent calculation. Again, both parties should agree on what's included and excluded. in working capital. An example of an item that would be excluded from net working capital would be customer deposits. So this is treated like a debt-like item because essentially what it is the client has, or the seller has received money for services or work that's going to be done in the future. So there's a liability that the buyer would be inheriting. So any cash collected on those future promises should be delivered to the buyer at close. What you want to avoid is the seller taking the cash out of the business for future work that needs to be done, and then the buyer being left to fulfill the obligation without the cash to do so. Because there's going to be things that need to be expended to fulfill those obligations, like payroll, materials, labor, things like that. So we would exclude customer deposits from net working capital, and that can always be a tricky topic, depending, because the seller again is going to say, well, it's our cash, we collected it, we're going to take it. So we kind of have to explain why it would be left in the business for the buyer to assume. And then this graphic down below just shows you again kind of back to the purchase price and how net working capital will differ at close based on the actual versus the target. And again, it is a dollar for dollar adjustment. So again, a dollar equals a dollar. So whatever that adjustment ends up being at close between the target that was established and agreed upon between both parties, it'll just be a purchase price adjustment at close. I think with that, I'll hand it over back to Mark.
Yeah, so just another couple of things to consider as part of the transaction, or sort of structuring or deal considerations, is what the owner, the seller should determine what will his or her involvement be after the transaction closes. So all too often we get our clients who are selling their business expect that within a short period of time that they're going to be retired and enjoying rounds of golf down in Florida with their family. And many times the buyer expects a transition period. So it's kind of understanding what that might look like. And then what's going to, most importantly, sellers are always tend to be interested in what's going to happen with my employees. It's a really important topic. And so getting some semblance or agreement in advance prior to close, I think is very important. And that tends to be important for the buyer too, for transition purposes. I'm going to skip over to, I'm not going to cover reps and warranties here. I'm going to want to move on to Mike's tax area. But I do want to mention about owned property. So this is a common conversation that many times property is owned in a separate legal entity and the operating company is charged rent. And so it's going to be important for the buyer and seller to agree, is the real estate coming with the transaction or not? And if it's not, the seller's going to retain ownership. There has to be an agreement as to what the rent looks like. And if that rent is different than what has been charged to the operating company in the past, there's an impact to earnings and EBITDA. And if it impacts EBITDA, then there might be an impact to the purchase price. So it's just an important thing that we think, try to handle that, as well in advance as possible. For planning purposes, to make sure there's no, disagreement in terms of what's going to happen with the real estate. So with that, I want to turn it over to Mike, who's going to cover some tax considerations.
Yeah, thanks, Mark. So we wanted to just sort of close the loop on asset versus stock deal and talk about two alternative ways to achieve sort of the best of both worlds. And that is a continuity of legal entity, a single level of tax for the seller, and a step up in basis for the buyer. The 338H10 election has been around for a while. That requires that the selling entity has a valid S election in place in order to play out the way we want it to play out. The F reorg option, which is kind of the new kid on the block and something we're seeing more and more of in a lot of our deals, doesn't have that requirement associated with it. Most of the deals we've been involved with, many, if not most, are involved privately owned businesses that are operated as S corporations. And often in the private company world, the business will engage in transactions such as mixing business and personal expenses that have the potential to inadvertently terminate the S corp election. If the IRS were to determine the S corp election was inadvertently terminated and we were relying on 338H10, if it were determined it was inadvertently terminated in a previous year, but after the closing, the results would be catastrophic to both the seller and the buyer. So to avoid this potential risk, buyers are more and more requiring an S corporation seller to engage in a series of pre-closing restructuring transactions called an F-reorg. And those transactions had the effect of removing any taint from the prior actions of the sellers. We've now worked on probably a dozen or more F-reorg restructuring transactions. We've now got an established framework, draft documents for executing the steps needed to complete the transaction. And this is something we're seeing more and more of in the deals we're involved in. The IRS has explicitly approved of these transactions in a number of published rulings, so there's a clear path to follow and not really any uncertainty as to what the results are going to be.
All right, as we're wrapping up, our experts want to know a little bit more about you again. So I just want to kind of get our last poll question, or one of our last poll questions up and going. Based on what you learned today, how are you feeling? Hopefully everybody's on track. Everybody's feeling good after this. Everybody's in good shape, but let's see how this comes in. And if you've already done the poll, feel free to jump over to the question area and submit any questions that you have for our experts. What do we think, guys? We had some good questions come out of the audience, so I'm assuming everybody.
I think it's probably, early in the process, just learning to, based on the results of the first poll.
Yeah. And I think, Carolyn, you're going to put up our contact information at the end of this. So again, we're happy to take any conversations or questions offline. Set up a meeting with Pat, Mark, Mike, Ryan, and we'll be happy to walk anyone through the process if there's any more detailed questions. I know this is we only have an hour and it flies by, so we just threw a lot of information at everybody. So happy to talk to anybody offline for just additional questions.
Great. Let's see what our results were. We kind of had a 50-50 split.
Nice.
50% of people are on track, and those are just starting the process. So I'm glad they joined us today so that they can be in good shape as they go through this. And then just our last question, and then yes, I will jump to Q&A after this, and also sharing our contact information of our experts. As we plan this series for 2025 and 26, what other future topics are you interested in? Let's see what everybody wants to hear about. Some mixed, a little bit of everything. All right, a lot more webinars from you guys. Lots of topics to cover. So
What's crazy, Karen, is that again, we just threw a bunch of information in this one webinar. I think we could make a webinar on each one of the slides.
Yeah.
We could do a whole webinar on tax, probably multiple on just tax alone.
Sure.
Multiple on working capital and.
Thanks. Your friend made work for me?
Yeah. I think you just said, oh, there's more webinars.
Yeah, there's a ton we can talk about.
There is, that's for sure.
All right, I'll just close it out real quick just so we can get moving to the question and answer. But again, a lot going on here, a lot of topics I still want to hear on or take deeper dives. So yeah, your work cut out for you guys. Again, throw any questions into the question box. I think there's a couple that have come in that Josh was going to take next. But also want to share with you, we have some upcoming webinars that you may want to sign up for. So here's a lookout. 2 webinars and 1 in-person event. So we'll send you that today. And Josh, I think there was a question that came in for you, if you want to take that one.
Where do you see that? Which one?
Let me see. Oh, I think it got answered throughout the webinar, so
okay.
Not a problem. If anybody has a question, throw it in here before we sign off. Thanks for joining us today. And we look forward to continuing this conversation and continuing this topic. Thank you, everyone.
Thanks, everybody.